My name is Alex Wright. I'm here with Drew Wright. We work with First Heritage Mortgage. My NMLS ID number is 1615455.
And mine is 589-370.
He's not old enough to forget it yet. So, when it comes to what we're going to talk about today, we want to talk about the new conforming loan amount that's going to come out at the end of November. And so, this is important to homeowners and buyers because the size of your loan impacts your rate. And you may be thinking, well, how's this super important to me as a buyer or homeowner? And rates impact your mortgage payment. So if you have a certain loan size, depending on that loan size, it's going to impact your payment. And so a conforming loan amount is a loan amount that's under $766,550. So if you're under that, you're a conforming loan. If you're above $766,550, that would be a jumbo size loan. And so what's going to happen at the end of November is they're going to make the conforming loan size actually larger. It's going to be
Right. They're going to be. It's probably going to be close to $800,000, maybe 802, and they do this every year because prices increase on homes. As prices go up, then they need to adjust the conforming loan limit so that more loans are captured into that. So what this means with their conforming loans is that Fannie Mae and Freddie Mac, the government-sponsored entities, will buy these mortgages directly from banks and mortgage companies. And the reason, well, I'll let you talk about that a little bit, Alex, about you mentioned that earlier.
Yeah, so when it comes to the conforming loan sizes, banks and lenders, they fight over this business a little bit more because it has so much fee income. When you have conforming loan sizes, the fee income that Fannie and Freddie will pay lenders or banks is significantly higher than the interest they could make in a short term.
Yeah, for example, if you take the new loan limit, we expect to be $800,000. Lenders expect to make the fee income of something equal to 3 points on these loan amounts. And so if they're making 3 points, each point is 1 point, or 1 point of $800,000 is $8,000. That means they're making 3 of those points, which is $24,000. They made it immediately. They just made a loan, they booked it, and 30 days later or less, they sell it and make $24,000. As opposed to earning interest and the cost of funds and their spread, if they're making 5 or 6% on a mortgage spread of cost of funds over depositors' money, that's not even maybe more than $3,000 or $4,000 the first month, and they got to make it several months before they're going to be at $24,000, and they have all the rate risk and they have all the credit risk in case of default. So they save those. They want to save their money, so to speak, for what we call jumbo loan amounts.
That's right. And so that conforming space, again, is super price competitive when it comes to lenders wanting those loan sizes. And so now that loan size is going to increase to approximately 800, there's going to be more competition for those loans, and it will help more people technically for primary home specifically. So if you're a primary home buyer, you'll be in this more competitive, slightly lower rate space. So for example, a primary home rate with 20% down today is roughly 6.5 with no points, versus a jumbo loan rate today, a 30-year fixed 20% down, is probably closer to 6.875. So you can see that the conforming loans for a primary home are a little bit lower, priced just a little bit lower, and that's because they want this fee income when they sell the loan to Fannie and Freddie. Now, we live, or predominantly lend in the Outer Banks, North Carolina, which is a coastal community where people come to visit here, and the properties that people buy here typically are rented seasonally, so they're considered either second homes or investment properties. And you can kind of see right behind us, the Outer Banks is such a kind of a unique area to lend in because it's surrounded by
It's
water.
the coast.
It's very
People
much
want
the
to be
coast.
here for coastal reasons, not maybe necessarily year-round reasons. So these properties are predominantly second homes and investment properties. And unfortunately, Fannie Mae created these, as they created these conforming loan amounts, they created these risk pricing adjustments, and they call them loan level pricing adjustments, or LLPAs. And they started viewing second homes and investment properties differently than they have for many years. In the first 30 years I was in the mortgage business, second home rates and primary residence rates were really the same, 6.5%. You came in, there's really no difference. Today, Fannie Mae's decided that they feel like second homes and investment properties are really basically the same thing, and they added these loan level pricing adjustments and made those rates higher. Essentially, what they did is they added points, is what they really do. They tell lenders, well, you got to add points to these loans, so you can't get 6.5 with no points on a second home. But nobody wants to pay 4 points or something like that, which is what it would cost if you just did a straight up 80% loan at the same rate. And so lenders have raised the rates on second homes to say 7 or 7.125, a half to 5/8 higher, and still have 1% on these loans at an 80% loan to value, meaning they're putting 20% down. Now, these are loan level risk pricing adjustments, and they do decrease as borrowers put more money down on these second homes and investment properties. So 75%, those drop a little bit, and at 70%, they drop a little bit more. The problem is that historically speaking, and all the investment, people that tell you want to buy how you want to buy real estate will tell you that, oh, you really want to put down 10 or 20% on these properties because you're going to rent them and they're going to cash flow, and there's no real benefit of putting 25 or 30% down. And so
what happens is that those adjustments that are 2 or 3 points, and just to back up a little bit there, when he says that's going to cost you, 2 to 4 points, when you purchase an $800,000 home, as an example, that's going to fall in this conforming loan space, and you have to pay 2 points. Let's say your loan amount's roughly $700,000. Well, 2 points would be, 1 point is $7,000, which is 1% of the loan amount. That's 1 point. 2 points would be $14,000. And when you purchase a home, you already have the traditional closing costs of attorney's fees, which is just like a settlement fee, and title insurance. Then you have lender costs as well, which is processing and underwriting a credit pull. And then you have insurance as well. So those fees typically, for just regular closing costs, if you're going to buy a primary home or a second home, they're about $10,000 or so. Well, when you add on the points to that of 2 points, that would be $10,000 plus $14,000. That's $24,000 in total closing costs, and that just seems like a really high cost for borrowers. And so therefore, a lot of times in our market especially, a lot of people just end up paying cash because they're like, I'm going to pay $24,000 in closing costs and my rate 7%. This just seems like not such a great way to use money. And at first you might say, well, Alex, not everyone's just laying around with $800,000. And that's true, they're not. The reason I know that is because often I'll help people become the cash buyer. I've done that in the past where, on the actual settlement statement, that looks like they're paying cash. If you looked at the records for Dare County or the county we live in, it's going to show cash, but really they got financing in their hometown to get that money out at a cheaper.
We did the mortgage on their house back where they live. We gave them a home equity line of credit. They did a combination of equity line and maybe a margin on their stocks or something like that. Not ideal. We've also made a habit of calling cash buyers and found out, hey, the cash buyer is, I pay cash technically from the settlement standpoint, but this is how I really did it, and I'd love a solution and that would work.
Because it's really only a temporary solution. When you get cash out of your primary residence, it's not a long-term solution at all, and that's a big problem.
Part of the reason we're talking about this today is, what are solutions that we can offer in the marketplace for our sellers, our buyers, our realtors, our builders, and the people in our community to keep our real estate market on the Outer Banks being active and people wanting to buy here. We don't want people not to buy here. We want the not have objections to be, oh, the rate is that high and I got to pay 2 points. So one thought that we've had is that as we educate builders and realtors is, make sure that your listing that you're getting understands the environment for mortgage financing is different on especially these conforming loan amounts, these properties that are priced at $1 million that are going to borrow 20%, $800,000, because those buyers and those sellers may not be aware of this market and how the rates are different. So we think it's really a great opportunity for realtors to add value and know and inform their sellers about our market, and also possibly encourage them to consider paying 1 or 2 points in closing costs based on their sales price. It really will separate them out from possible other listings so they can sell their property quicker. And it's helpful for builders to have the conversation so that people aren't surprised after they get the building price and everything else. They're going, "Ooh, I can't find a mortgage that I like." That solution, that's one idea. The other idea is to make sure that borrowers are aware there are alternatives to the traditional 30-year fixed rate Fannie Mae loan.
There's ARMs.
So, right.
The ARMs are adjustable rate mortgages. And
right.
So there's 3 categories of ARMs.
Yep. So luckily, not every lender is going to have this. This is going to vary from lender to lender. But luckily, we have come to work for a company called First Heritage Mortgage, and we've got these portfolio loans. And remember, these portfolio loans are not really, this is not what banks want to do. They want that fee income. So this is great that we actually got a bank that's willing to not get the fee income and actually just take the interest income. And so these are fixed rates for 10 years, 7 years, and 5 years. That's the 3 products Alice is talking about. And so you still get your 30-year term, so you get the lowest possible payment. The rates are locked in for each period. Nothing changes for 10 years or 7 years or 5 years. Each rate correspondingly goes lower as you shorten the term of the rate commitment. And then you can borrow money without paying any points.
Yeah, so what do those rates look like for the adjustable rate mortgages?
So the 10-year rate starts at 7, the 7-year rate starts at like 6 3/4, and the 5-year rate drops down to about 6.5. So each one's about 1/4% better as you shorten the term of length of rate lock.
In 5 years, honestly, I mean, if I was a consumer, it's not a very long time period. But if you look at historically, 7 years is typically how long you own a property, at least from a consumer to own and sell a house. If you look at that average, it's about 7 years. So 5 years, that rate is lower, but I could see myself wanting the 7 or the 10. I think it's just worth pointing that out, that I try to think of what would I do myself and how can I best help my buyer and give them the best advice possible. But people do occasionally pick the 5. And just to reinforce, those are second home rates that we're offering with no points. So we're getting rid of that objection that we originally brought up, where 30-year fixed rate have those pricing adjustments where it's 2 to 4 points. So if they're willing to do an ARM, we can go ahead and get rid of that objection. And if the listing had a concession for closing costs, they could just apply that to normal closing costs. Again, incentivizing people to make an offer and get more attractive financing in our market.
Right. So, the thing is always looking for solutions. There's always a way around something in the mortgage industry. You just have to be looking for it and have, people that are really trying to do the best thing for the consumer. That's what we want. I want to be the best provider for my consumer we can be. So if we can ever help somebody with a mortgage, please send them our way.
Yep. And if you want to read our take on this in a newsletter fashion, we have a link for our newsletter that you can read our newsletter, and you'll have our contact information below. And so we hope you reach out when it comes to buying property, whether it's a second home, primary residence, or investment.
And feel free to share the newsletter with any of your friends, customers, prospects, or anybody that you think could benefit. Thanks a lot.